Hey everybody, Chuck Barone here. Today is Monday, January the 30th, 2023. Here we are at the start of a very big week this week, guys. We got a lot of stuff to go over this week. We know the Fed's having their open market committee meeting starting tomorrow, big day Wednesday. It's going to be affecting these markets, it's going to be affecting your investments, and pretty much the fate of the world is waiting on these big decisions coming up this week. As always, before we start the show, I just want to welcome you guys to the show. Thank you for your support, everything you guys do every day, watching the videos, sharing them with your friends, your likes, your questions and comments. We appreciate you guys, really do. Markets today, everything was down today, pretty much except the dollar. It's just a real nothing burger, though, because all they're doing, the market is pretty listless right now. There's a lot of uncertainty, as we've been talking about on the show pretty regularly. So the market just has a gain and then gives the gain back. And that's kind of what it's been happening. It's just been seesawing back and forth. There's no real direction to the market. We have, with all the conflicting data and the uncertainty about the Fed, the economy, is it going to be a recession? Have we had a recession? Are we in a recession? How high will the Fed go? How long will they leave rates up? You got your hawks and your doves on all these stories fighting back and forth. So it's just going to make for a pretty listless market. These day-to-day moves, well, like we're going to talk about them, really just aren't big in the big scheme of things, aren't really that important until they start to become a trend. So anyway, stocks down across the board. The NASDAQ taking the biggest poop today. S&P right behind it. Dow down almost 300. Just not a great day. Bonds today also down today, but not a lot. 10-year sitting at 3.55%, up 3 basis points. 2-year following suit, up 3 basis points at 4.24%. So basically we got a 70 basis point spread inversion, which is telling us a recession coming. A lot of the data says it, but a lot of the earnings companies are reporting aren't showing it. So it's going to be fascinating as we move forward. Today, the dollar rallying a little bit, back up over 102 on the index, 102.26. Not a great number for the dollar compared to the 109 it was, but nice to see it rally back a little bit. Is it really a rally? Is it, dead cat bounce? We'll see over the coming days. Metals today, with the rally on the dollar, of course, metals down, small down day. Gold down $4.90 at $1,923 per ounce. Silver down just 2 cents, $23.67 per ounce. Great numbers for metals, man. They look very attractive to me. Even though they've had a nice little rally, I think there's still some legs on this rally. Oil today down $1.86 per barrel. West Texas Intermediate dropping $77.85 per barrel. Maybe we're going to start seeing gas prices start coming down again. Something I certainly would be okay with, and I'm sure you would too. Bitcoin today giving back some profits, down around $926, but still sitting at 22,796. It had broken above that 23,000. It looked like Bitcoin was ready to rock and roll. But with what people have experienced in Bitcoin, with the massive ups and the massive downs we've seen, not a surprise that people who own it are taking a little bit of profits. As it comes back down, they'll be probably using those profits, buying back in at better prices. So Bitcoin holding its own. This week, like we do every Monday, we're going to give you guys an idea of the data coming out this week. There's going to be a lot of stuff. Today, Monday, quiet day, just pretty much corporate earnings. We've already seen some of those come out affecting the market today. Tomorrow, we'll get the Chicago Purchasing Managers Index, which will give us a little bit of an idea of how they're doing on prices and how businesses are buying. We'll get consumer confidence numbers, which are expected to be up. I was surprised to see that. We'll get employment cost numbers, and this is an important one because this is going to give us an indication of what we can expect on Wednesday when the Fed announces their rate increase. The big driver of the inflation, especially according to what the Fed is thinking right now, is this sizzling hot job market, wage gains. So employment costs, if they're expected to be up already, they come in higher than expected, could be foreshadowing a surprise for us on Wednesday. On Wednesday, of course, we know that's the big day with the Fed, but we're also going to get construction spending expected to be down. We're going to get mortgage bankers index. That's going to be down. We're going to get the ISM manufacturing index. So we'll see now, manufacturing was kind of hanging in there. Now the manufacturing numbers have been coming down, so that's going to be an interesting one. But of course, all of that's going to pale in comparison to the big Fed event on Wednesday. Thursday, the day after, we'll get factory orders, which will give us an idea of how factories are doing, what they're selling, how their inventories are growing. We'll get initial jobless claims, which is going to be a big one, man, because the job market has continued to surprise. Jobless claims actually coming down. The claims have been less than they've expected, and they've been bringing those numbers down pretty significantly. So it's going to be, we'll see where that goes. We're also going to get worker productivity numbers, and we're going to get unit labor costs. Again, these are all important releases, important data to give us an idea of where interest rates are going. Everybody kind of has settled on this idea that it's going to be 2 more quarter-point hikes and done. I believe we're going to get at least 3 more. I was reading some economists believe they're going to raise every meeting through May. There's a lot of different ideas on exactly what's going to happen and how they're going to play all of it. And it's all going to make a difference in your 401ks, in your savings, what you're earning, what you're making in your savings at the bank, and your money markets, and everything else. Friday, capping the week, we'll get the non-farm payroll numbers, which is just another employment indicator showing, I'm sure that's going to be a number the Fed's not going to like. And we're going to get the new unemployment rate, which is actually expected to go up from 3.5 to 3.6. So we'll see where that goes. On Wednesday, that's the big day this week, guys. That's the day that the Open Market Committee will announce their rate hike. It's broadly expected to be a quarter-point hike. I tend to be believing that's probably accurate. But some of this data this week, the Fed probably having access to this data long before we're going to get it. So they already know what these numbers are going to be looking like. And if a lot of these numbers are pointing to more inflation, I think that while the Fed will only raise a quarter, the big event of the day, as we all know, is going to be their policy paper. They release it that day. And then, of course, you got St. Jerome, the miracle worker in the bond market, who will have his news conference that Wednesday as well. Now, he'll be probably, he's going to want to talk tough. He's going to want to sound hawkish, discourage the market from this idea that it's pivot time. But the real big one is going to be the policy paper. And that's going to tell us really where they're at, where they see the economy going, and basically will give us a better indication of what their real intentions are. I think that with some of the, again, the data's just been mixed as far as recession goes. I was reading an interesting article making me laugh. They're still talking about this soft landing. I don't know if we've ever, I'm trying to remember if we've ever had one. To my knowledge, we never have, at least what I can remember. And I always joke around, you've heard me say it, soft landing, picture the Hindenburg, exploding into flames. That's typically what their soft landing looks like. So let's not plan on a soft landing. We're either going to have a recession or we're not. I would tend to believe we are. So now the question just becomes, how severe will it be? And wrapping things up today, guys, I just want to talk about consumers and consumer spending for a second. I hope a lot of you guys that have been listening to the show, our regular viewers, have been taking heed and doing some of the things we've been asking or advising you guys to do. One of those things was to be more thoughtful about how you're spending your money. And another thing was to not accumulate any new debt if you can afford and absolutely afford not to. Well, here's some data coming about that was interesting today. I was reading. Consumer spending, the consumer's just about done now, guys. And that's going to be the big final indicator of the recession, right? Because consumers are 70% of our economy. So if they're tapped out, that pretty much means our economy's tapped out, right? So what is the data telling us? Well, check it out. Consumer spending has been down 3 of the last 4 months. Spending on services, which was the most recent report that came out, just had its worst showing in a year. You have just home sales completely in the toilet, which are a huge driver of our economy. The auto industry just had its worst year in a decade. Home sales down lower than they were in 2014. The savings rate, during the pandemic, I was kind of getting excited thinking maybe consumers were coming to their senses with this COVID scare. Savings rate was approaching 8%. Now it's about 3.3%. So the consumers aren't saving. We've already talked on the show a bazillion times about consumer credit and consumer debt skyrocketing like crazy. So consumers have carried us and kept this economy going, blowing through savings, accumulating debt. Now the data is indicating that though the consumer's about tapped out. Now that's why we saw a decrease in spending in December, which is pretty rare. I think that consumers are just tired. They're seeing the payments on their credit cards going up as the rates are going up on those cards, and on all the debt they have that's adjustable is adjusting up. And I think they're just tired. So we'll see what happens going forward, but this is going to be a fascinating week. We're going to be here every day to give you guys the details and make you understand how it affects you, how it affects your portfolio going forward, some ideas you can use, simple stuff that might help make you a little more wealthy. Anyway, guys, that's it for today. We appreciate your support. You guys rule. I just want to apologize for my casual attire today. You know, I've been trying to fancy it up a little bit, but it's a really crummy day out in Vegas today. 40 degrees, cloudy, rainy, cold, and damp. And not only that, I wanted to show off my new Bills hoodie because even though the Bills lost, I'm loyal. Yay, go Bills. Anyway, we're back tomorrow. We appreciate your support. As always, if you like what you're hearing, hit the like button, share the video with your friends, ask your questions in the comments section. We'll be back tomorrow bringing you what you need to hear. Until then, guys, take care. Thanks.